Okay, so I'm just going to go over the second homework assignment. And the first question was, the spirit of the first question is basically the idea of modeling. We're basically using this idea of using an Ito process. An Ito process has two components to it. One component, which is non-stochastic, and that is meant to represent some kind of a drift. It's drifting upward. If it's something that increases in volume, it could drift downward with time if it's something that decreases in volume. And then there's another component to it, which is the Martingale component. That's the component that has an expected value of 0, but just has some kind of variability to it, something we can't predict. So this is what we've been doing in this course, is modeling stocks and anything that fluctuates in price. Generally, anything a person would purchase over time is expected to fluctuate upward. So it fluctuates, meaning there's risk involved, and it's expected to go upward because people want to get a bigger return over time for their investment today. So what this question is saying is, if we were to take the Philadelphia Phillies, which is I guess the closest baseball team to where we are. Actually, we're located halfway between New York and Philadelphia, so I could have done the Mets or the Yankees too. And we're going to try to model, in this case, we're going to try to model their winning percentage. Not the number of wins they have, but we're going to try to model their winning percentage. So that's what made this question kind of tricky. So it was intentionally made to be tricky. If you get used to doing the stock version, where the stock price is expected to go up, you would have a non-stochastic component that goes up with time. If we were modeling the Phillies, how many wins they have, let's say today they have 20 wins, you would expect that to go up over time, as long as they can win a game here and there. But their winning percentage is expected to do whatever you think it's expected to do, but I guess we'd have to assume that whatever their winning percentage is, it would probably stay the same over time. So the winning percentage is a Martingale process, so there should be no drifting part. Okay, so we'll get to that. I think that comes up in part C of this question. So anyway, if you wanted to model the remainder of the Phillies season, assuming they've already won 60% of their games, maybe they've played 10 games and they've won 6, maybe they've played 100 games and they've won 60, but at some point in time we stopped and said, well, we've noticed they've won 60% of their games. If they were to continue, if their win percentage was to continue to be a Martingale process, what explanation for what you expect to happen for the rest of the season would keep it as a Martingale? And that would be if the Phillies' winning percentage, the probability of winning their next game, is always equal to whatever their current win percentage is. If you said that the Phillies' win percentage is 60% for the remainder of the game, that wouldn't be true. In fact, as soon as the next game is played, that would no longer become true. If they win the next game, their win percentage goes up a little. And you're saying it's going to head back towards 60. So they might win a game and then they'll be up at 62%, and then you're saying, no, they're going to go back to 60. If they win the game and then go up to 62%, then the expectation is they'll stay at 62% for the rest of the season. Every time a game is played, the percentage changes, and therefore the expectation for the next game after that changes too. So you wanted to make the statement a little bit more vague. You want to just say the probability of Phillies winning their next game is always equal to whatever their current percentage is. Then it would be a Martingale process. So the next question said, think of a way to describe their, how you would predict their future games based on, come up with some statement that would not be Martingale, however be Markovian. So for something to not be a Martingale, its expectation is that it will somehow change. If it's a Martingale, its expected value is to not change. That's the definition of a Martingale. A Markov process is something where you can predict the future by just knowing the current value, not how it got there, but just the current value, and then knowing something about the random variable of the future. So for example, if we said, the Phillies are going to win their 50% of their remaining games. Okay, that would not be a Martingale process anymore because they're currently at 60% and we're saying they're going to go down to 50%. But it is Markov because, it's Markovian because we don't have to look at how they got to the 60%, we just know they're there. If we had said something, I just put this in as a note, if we said something like the chances of them winning their next game is equal to the average of their 3 most recent games, then we have to look back into their past to figure out the future. So that would not be a Markov process. Okay, now the third one, this was, like I say, a little bit tricky. So the third question says, let's create an Ito process to describe their win percentage. If we were modeling how many games they were going to win, the number of games, then we would have a component that goes upward, because we would expect it to go up over time. Unless they're going to lose every game for the rest of the season, we'd expect it to drift upward. And then there'll be a random part. But since we're modeling the percentage of wins they have, it doesn't drift. It's actually a martingale. Under the assumption of part A, under the assumption that their win percentage is going to stay the same, the drifting part doesn't exist. This is the drifting part, this is the martingale part. So this is the part that makes it not a martingale. So if you're ever modeling something and you don't expect it to drift away from its current value, this component doesn't exist. If you expect it to drift upward like a stock drifts upward with the interest rate, then this would exist. If it's somehow randomized, this component exists. So so the spirit of this question is anything that has a randomness to it and a drift to it is an Ito process. And it's not just, in stocks, it's in baseball, and it's anywhere. Anything that has a randomness and an expected drift. So their percentage is, their percentage of winning remains the same as games go on. So what we would end up doing is we would have dP, and then this is just the stochastic component. Now here's what makes this question a very interesting question, is the fact that our variance, which is being modeled here, changes over time. We've seen most of the examples we've covered in this class. The variance is a constant, like the variance is 30%, and it's just 30% for the next 6 months. It doesn't change over time. I just wanted to have an example of something that we could all follow, where the variance would actually be a function of time, not just a constant, no matter what the time is, but a function of time. And if you think about it, if the Phillies have played 10 games, and they've won 6 out of 10, and they're about to play the 11th game, that 11th game, win or lose, will carry a big weight in altering their percentage. If they played 150 games, near the end of the season, the next game will not alter their weight too much. So the variance as time goes on, for the modeling the Phillies' win percentage, is diminishing over time. So the variance should get smaller and smaller as time gets bigger. So as little t, which is the variable, and big T is the last day of the season, little t, as it gets closer and closer to big T, this thing gets smaller and smaller and smaller. So on the last day of the season, this would be, let's say the season was 162 games. This would be 1 divided by 162, so it would have a weight of 162nd, 162 second. And at the beginning of the season, it would have a lot more weight. So this is an example of, so it's just something we're not used to. We first of all have no non-stochastic part because it doesn't drift. The win percentage is by itself a Martingale process, so the drift part's not there. And then the sigma is actually a function, not a constant. So simple thing like, let's model the Phillies' remainder of the season, the win percentage process actually turned into somewhat of an interesting Ito process. Okay. The next question was on Brownian motion, And the question was saying, okay, so this was kind of, we had to do a goal seek kind of thing. We know the answer, we need one of the input parameters. So this question is saying, you're starting up a hedge fund and you need to raise some money before you start investing. Based on the way you're going to invest, your fund will be like a Wiener process with a drift of 0.5 per quarter and a variance of 4 per quarter. How much money should you raise initially before the fund gets started so that the probability that the fund will not zero out within a year is greater than 5%. The probability that you will zero out is less than 5%. There's a 95% chance that after a year you'll still have some money in this fund. So it looks like it's a very high risk fund, and you may make a lot of money for your clients, but you may also lose all that money. And you want to be able to tell the clients, well, there's a less than 5% chance we're going to zero out within a year. So how much money should you raise? Obviously, if you started with a very low amount of money, there's a very good chance you'll zero out quickly. If you started with a huge amount of money, there'd be very little chance. So what's the minimum amount you need so that the percentage of zeroing out is less than 5%? So what we could do is basically we're going to take the amount of money you're starting with, X, and then add 4 times the 0.05 for the drift. And then we're going to take a normally distributed random variable with a mean of X plus 4 times 0.05 and a variance of the square root of 4 squared. And so that ends up being this normal random variable, X plus 0.02 with a variance of 4. And then we go and we want to plug this in to get the z-score of a unit random variable. And this gives us, the z-score here is, we're basically looking for the equation where this becomes true. So we want to know when the unit normal for this quantity, the negative sign in front of it, is less than the 0.05. The percent, we want to have a percentage less than 0.05 that will zero out. So now what we have to do is we end up with an equation like this. This is, when we look up the value on that chart or on your calculators, this is the value for this variable. And then what we end up with is we have to then solve for x, and when we solve for x, we get x equals 0.4579 million dollars, since the question was quoted in millions of dollars. We would need $4.5 million to start the fund so that there would be a less than 5% chance that we will hit a balance of 0 within 1 year with the way we plan to invest this money. Okay, so yeah, 4.858 million. Okay. The next question was, okay, we're basically given a, suppose that we have X, the yield to maturity of a continuous compounding 0 coupon bond that pays off $1 at some time t in the future. Assume that X follows this Ito process. So here's what X follows. That's some process X, and that's its function. It has a drift of A plus X naught minus X. So this is kind of like the first question about the Phillies game, except that now the drift component is not a constant, it's actually a function of time. But we've just seen that before, it's not a big deal that it's a function. So as time goes on, it changes its value. It drifts differently as time goes on, as the value of X changes. Okay, so this is the process for X. Now if you remember what Ito's lemma says, it says if you have one Ito process, right? An Ito process has a non-stochastic component that drifts and a stochastic component that is random, and it's a Martingale. So it's random and it's multiplied by some factor, but it's this is a unit normal distributed random variable with an expected value of 0. And then this is some amplification of that. So this is a martingale and this is a drifting part. So, according to Ito's lemma, if you have one martingale process and this process is input into another function, any function, you can make up any function you want, this statement will be true about the function you made up. So the function for a bond is just e to the minus xt times the remaining amount of time. So that's the bond process. So we take, here's x, we then take this process and substitute it into x, and we have our new function. According to Ito's lemma, we should be able to crank this whole thing out, and that's the process for the bond. So in order to calculate that, we have to calculate our derivatives. So Ito's lemma says that the derivative of our new function, which the textbook usually calls the g function, but we're calling it b because b is the first letter of bond. The derivative of the bond with respect to x, partial derivative of the bond with respect to x, would be, using this, we would get, this is the partial derivative. And then the partial derivative of the bond with respect to t ends up being this partial derivative, which ends up equaling x times b. And then also for Ito's lemma, we need the second derivative with respect to the original Ito process. So we need the first derivative with respect to time, first derivative with respect to the other Ito variable, and second derivative with respect to the other Ito variable. So in this case, none of these zeroed out. Usually on the easier questions, they zero out. Usually a test question, one or two of these will become 0. It makes life easier for us. Well, this is a homework question, so we can spend a little more time with it. And we end up getting the new process according to Ito's lemma, the new process for the bond, which has that x as its underlying process, ends up being this, according to Ito's lemma. So this is the process for the bond that is based on that variable, that Ito process x. Okay. And then the next question is a Black-Scholes application. So, it's all on one screen. Alright, so I kind of cut out the words of the question, but it's basically saying this. We have a stock that is currently $69. We have a strike price of 70 for a, looks like a put option because of the minus signs. Let me just double check that. Yeah, European put option. Okay. So, we're pricing a European put option. There's two values we have to calculate, the D1 and the D2 from Black-Scholes formula. This is used for calls inputs, and you'll have to calculate this either way, D1 and D2, whichever option you're doing. And we got D1 is equal to the log of the, the current stock price minus the strike price plus the risk-free interest rate minus the variance squared over 2 times the remaining time. And the denominator is, variance times the square root of remaining time. This comes out to this number. D2 is equal to D1 minus the variance times the square root of the remaining time, which comes out to be this number. The price of the European put, you then just plug that into Black-Scholes equation. And after you clean it up, we get $6.40 is the price of a put on this option with this input data. Okay, the next question, the last question, was basically saying this. So I just kind of wrote some notes down, step by step, how to do this. The question was basically saying, take the 5 input values for an option, and the 5 input values are the 5 inputs that the Black-Scholes formula needs is basically the current strike price, the current price of the stock, a particular strike price. We have to know what the risk-free interest rate is. We have to get that from somewhere. The variance, which we have to get from somewhere, and the time remaining until it expires. So, the current price, at any point in time, the stock market will tell you that. And then all these websites like Free Real Time and Yahoo Finance, that, you know, they'll always tell you what the prices are. Strike price is when you go look at the list of all the different calls, you pick a price of all the calls that are out there at some point in the future. You decide how far to go into the future, and the chart will tell you what the prices are for that time. The risk-free interest rate, there is no official definition of a risk-free interest rate, but a pretty common one to use in the United States is the United States government's bond prices for that amount of time. So if it's a six-month loan, you say, what would the United States government pay in interest for a 6-month loan? And that's considered to be the safest place to invest, is the United States government. It's believed to be the last country in the world that will go bankrupt more than any other country. So that's the closest thing to a risk-free interest rate that we have. So we could go out to the United States, the treasury.gov website, and it'll tell us what its interest rates are. So we could get the interest rate from a website, we could get strike prices from a website, we could get the current price from websites. These are concrete values. Time to expiration is a concrete value. What's not concrete is the variance, the volatility of the stock. The volatility of the stock, so if we were to pick a stock now and go pick and say 6 months from now we're going to price what an option would be, we need to know how volatile that stock will be over the next 6 months. What website would we go to get that information? There is no website. There is no way to know this for certain. So there's many different ways to try to take a guess at it. And the point of this last question is for you to come up with a method for how to guess at what the volatility will be. And then, so you figure out some way to guess at it. There's a couple of ways. You go on YouTube and just look for guessing at volatility or predicting volatility. And there's different people have different methods for doing it. So we'll just pick one kind of popular one. And we'll figure out a volatility for a particular stock and then figure out what would its Black-Scholes price be at that volatility, the one that we use. And then we'll compare ours to what the real price is, and then that'll just kind of tell you what the difference between the volatility we came up with and the volatility that the real market thinks is the appropriate volatility for the strike price at that time. And if you remember, volatility has usually that smile to it. It's not one volatility, it just depends on what option price you're looking at. So let's pick, for example, we'll take Google stock, because we know that's, this question's saying don't have a dividend. Pick a stock that doesn't pay a dividend. And then what we can do is we can go out to the internet and we can gather some data. So we'll take Google stock, which its price is, as of the close at the end of today, its price is $6.25. Let me just point at it. $6.25. This is for Google's price. The end of today, which is, today's date is December 12th, 2011. Google's price is $625.39. Okay, so That's the price of Google stock, and now we need to pick an option. Let's click on, so this is just, this is Yahoo Finance's webpage. And so what we'll do is we'll click this options button here. A little bit later I'm going to click this historical data button, so I just want you to know where these buttons are. Assuming Yahoo doesn't change its page format anytime soon. So I'll click on options, and it brings up the option series. And then these are the options that expire in December of 2011, which is actually this coming Friday, third Friday of the month, which would be 12, 13, 14, 15. Yeah, it would be this Friday. I'm going to go out 6 months from now. So I'm going to use a time of 6 months from now, and I'm going to look at the June of 2012 options. So I'll click on that, and that option series will come up. And then I'll pick a particular option that's maybe, $25, $50 out of the money. So I'm going to take a look at call options for $650 are the last trade that went through is $43.09. So $43.09. Let me write that down. The call price is $43.09. Okay. So, what can we do with this data? Oh, we also need to know what's the risk-free interest rate. So we got the current price of the stock, we have the strike price, we have a time in the future. So the time, actually, let's see. The options expire on Friday, June 15th, 2012. And today's June 11th. So that is 6 months and a week. 6 months and 4 days. So 6 months would be, time would equal 0.5, and then for the extra week we'll throw in another 2%, because there's 50 days in a year. When you subtract out holidays, there's about 50 days in the year. So we'll make time approximately 52%. 52% of a year. Okay, now, so we have our input variables, and we just need one more, the risk-free interest rate. So, let's go to, bring up another website, and we'll go to www.treasury.gov. And usually on the front page of the Treasury it gives its interest rates. And so here's the Treasury's page. And hopefully we're up to date for it too far. Yep, we have a curve right here. Okay. So this curve right here is basically saying if you want to borrow money for 1 month, 3 months, 6 months, a year, 5 years, 10 years, 20 years, 30 years. And it looks like it's somewhere between 0.5%. We're looking at the 6 month zone. Oh, actually if we put our mouse on here, it probably will tell us what the value is. So, yeah, so for 6 months from now, the U.S. government rate is 0.5%. If we were looking for options 4 months from now, we would kind of take an average of the 3 and the 6 and weight it 2/3 on the 3 side. So basically, you could take these numbers and then take some kind of weighted average and pick the time until your option expires to get the risk-free interest rate. So, like for example, it's 1% for a 3-month loan. 1/10 of 1% for a 3-month loan, and 0.5%. 0.05 and 0.01. So if you wanted to price an option that was 4.5 months from now, you might take an average of 0.05 and 0.01, maybe 0.03, something in that neighborhood. Okay, so now we have our risk-free interest rate. So we have all our inputs for the Black-Scholes. So we can use Excel or MATLAB. So I'll use MATLAB since it has a built-in function for the Black-Scholes price. So the Black-Scholes price of the option, and I preloaded this with the data we just gathered. That's today's option price, strike price of 650, interest rate of 0.05, duration until the option expires, a little more than a half a year. Oh, I'm sorry. This one actually we actually need to know the input, the volatility. So let's assume we don't have that yet. Let's figure out what the implied volatility is for Black-Scholes. So if we open this up, there's an implied volatility function. And so here we have the current price of 625.39, strike price, interest rate, duration, and this is the price that the options are selling for. So the market is implying a volatility of, the implied volatility according to Black-Scholes' formula for Google's stock prices today, a stock price, a stock option on a strike price of 650 with an expiration 52% of a year from now is 0.25 or 0.26, rounded out. So according to the market, the volatility for Google is 0.26, let's say. Now this question is saying we would like you to use Black-Scholes' model, but don't reverse engineer and figure out what the volatility is coming from the market. It's you figure out the volatility using some method that you dream up. There's really no wrong way to do this unless it's a crazy method. But what we want to do is we want to have figure out some way to calculate what you would think the volatility is, and then compare it to this market and just chat about it. My volatility is higher than theirs or lower than theirs. So one way we can calculate the volatility, and there's probably many ways we can do it, but one thing we could do is we could, so we may not need this anymore, we could go out to Yahoo again, and if we go back to the stock price, we can do something like this. We go to the stock price page, and then we click on historical prices. And that'll give us the data for, all the closing prices for pretty much as far back as we want. We could go back to 2004, so we could go back a good 8 years to get this data. If you scroll down to the bottom, there is a button that says download to a spreadsheet, and you can just say open it up. And let's see what happens. Is this thing still coming? Yeah, it's still thinking. Here it comes. Okay. Data's still coming. Okay. And then what we can do is, so this is basically data from the past year or so. And then these are the closing prices. This is today's closing price. That was the price yesterday. So what we can do is we can make a column. We'll call it the daily return column. We'll create a daily return column, and we'll say this is equal to ln the natural log of this, of today's price, equals divided by yesterday's price. Okay? And then we can calculate that for all the boxes below. Okay. Then we can make another column called the standard deviation. So we could put the formula in here, equals ST. You start spelling out a formula, and all the ones available in Excel show up. And the standard deviation would be, we'll grab a range of data. So this is not the greatest thing, but it's just something quick and dirty. We can pick like 10 days or so. And then just take standard deviation for that, and then calculate that formula going all the way down. And then what we could do is we could annualize this standard deviation. So these are daily standard deviations, and then the stock market's open about 250. Our textbook says 250 days, but it's popular to use 252. So we'll annualize it and say that this is, we'll say that this is equal to the square root of 252 times the standard deviation. So we end up with an annual standard deviation. And then we could then have, let's say, now at this point it's kind of your call. You can take an average of these annualized standard deviations. So this is basically saying, for the last 10 days, or however many boxes I grabbed up, the variance was 28%. And we calculated the implied volatility, the volatility was 28% for the last 10 days of the stock. We calculated that the volatility for an option 6 months from now at the strike price of 650. Remember, every strike price and every time has a slightly different volatility. Volatility is not constant implied volatility is not a constant. It has that kind of smile curve to it. But basically, the method that we just whipped together for calculating volatility, which is based on the theory that the volatility of the last 10 days will stay the same for the next 6 months, which is probably not true. But maybe something close to that is true. So now we have, this is the volatility for the 10 most recent days, then not counting today, but the 10 days before that, this was the volatility, and so on. So now we might want to take an average of these. Or some people would argue you can take the average. Some people might argue you might have 1 or 2 extreme days, so maybe it would be better to take the median. Either way is fine, whichever one you like. Whichever one you think gives you a better estimate, we could do. So we'll take the median to get rid of those extraneous variables. But if we say median, and then we need a range, and we just grab a range of numbers, and we close it out. The median looks like, for the last 10 days or so, looks like it would be 0.30, maybe 31%. And according to Scholes, it's at 26%. So basically all the people in the market for people who are in that market for the options with the strike price of 650 for June, their risk neutral price is pushing towards a volatility of 26%, but we've kind of discovered that the volatility for the last 10 days is 30%. So we might think the volatility is higher than the market believes it is, which would mean that we should buy the stock. We should buy the call and sell the puts. If our volatility that we just calculated is more true for the next 6 months than the 26% that the market is saying, we could actually make more money buying the calls and selling the puts. So really, that's what the point of this question was. It was basically the data for the current price, the strike price, the time till this option expires, and what's the other input? The rate, the risk-free interest rate. We can't really negotiate that. We can't say, oh, I have a better formula for that. Those, we have to live with those numbers. The secret sauce to calculating the price of an option is, how do you come up with the volatility? You have to come up with the volatility for the next 6 months. Unless you have a crystal ball, you can't figure that out exactly. So you come up with some method and then compare your method to the market, and you could buy and sell options based on how much you're different from the real market. If you're correct more than 50% of the time, you could make money, and if you're correct less than 50% of the time, you will lose money. So the idea is to be more than, come up with a method for calculating the variance that's better than the average person in the market more often than 50%. Okay, so then if we took this, our volatility, we can then use the MATLAB function for pricing the option, the Black-Scholes price method, which is file open Black-Scholes price. So if we wanted to price an option for Google for 52% of a year from now, it's 6 months and a week, and we use, what do we just find, 30.7 was the volatility. So if we calculate the price that we came up with our volatility, we would get, we would get a call option price of $51.60, and the real market price is $43.09. So according to our method for finding volatility, we got $59.52. The implied volatility from the market, I think, is 26%, we said before. So if we punch in 26% and calculate it, we get what is the current market value. 43. The current market, the last sale today was $43.09. So this is 5 cents higher. This must be because of the round down error. If I just kept the decimal going, it would have came out perfectly correct. Okay. So if the volatility we came up with is going to be the real volatility for the next 6 months, this option is worth, oh, that was the put price, sorry. This option is worth $51.59, not what it's currently selling for, which is $43. So if we came up with a better volatility to predict for the next 6 months, we should buy that option. We should buy this thing because we can get it at this price and it's really worth this price. And we should sell the puts because this is the current put price, and this is what, I'm sorry, no, we should buy the puts also. We should buy both of them, because we can get them for cheaper than what we think the price is worth and what the real market's selling them at. The real market's selling them at cheaper. So we'd be better off buying both of them.